Fellow risk takers, this is your worst. Podcast host Andrew Stotz from A Stotz Academy, continuing my discussion with Larry Swedroe, who for 3 decades was the head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry is unique because he understands the academic research world as well as the practical world of investing. And today we're going to discuss a chapter in his book, Enrich Your Future, The Keys to Successful Investing. And the chapter is 16 All Crystal Balls Are Cloudy. Larry, take it away.
Yeah, the story or this chapter begins, as all my chapters do, with a story that provides an analogy that helps people understand the issue. And then, if you understand the analogy in a common subject, you're able to then translate into investing. What's ironic about this, the timing of this chapter, will become evident to your listeners, especially those who happen to live or know people who live around Asheville, North Carolina.
Mm.
So in 1977, the spring, the people in a town called Grand Forks, North Dakota, became very concerned about the potential risk of flooding in what was called the Red River. Scientists predicted that the river would crest at 49 feet. And given where the flood stage would be, which was a little above that, they felt okay. The problem was the scientists didn't guess exactly right. The river crested at 54 feet and there was massive damage. People had to rapidly abandon their homes. Of course, the same thing just happened, we know, in Asheville, North Carolina, especially where people living in the mountains don't worry about hurricanes typically when you're central part of the country and up in the mountains. The problem with that line of thinking is it has to do with investing, is that all forecasts such as those that deal with estimations of probabilities, the problem is people tend to think of them in what I call a deterministic way. Okay. Let's say you're a baseball fan, you predict the guy's going to hit 300. Well, the odds are close to zero. He's going to hit exactly 300. The way to think about it is like a bell curve, normal distribution, where the median and the mean might be 300, but there's a 50% chance might hit more than 300, a 50% chance it hit less. Maybe there's a 30% chance it hit more than 320 and a 30% chance he might hit less than 280, and a 10% chance he has a really bad year, hits less than 250, and a 10% chance to have a great year, hitting, say, over 350. Well, the same thing is true with stocks. You get all these analysts, and I laugh when they predict the S&P is going to close at 59.13. Like, the position really is accurate, right? And it's telling you something, right? The only right way to think about that is that's your median of an estimate, and you should think about the possibility distribution of returns. And when you're looking at longer time frames, the same thing applies. We don't know. There is nobody who can accurately predict where stock returns are going to be
Mm.
because there are lots of surprises in the future. No one could have predicted, say, a 73.4 oil embargo. Uh, no one could have predicted the internet bubble and then it bursting. No one could have predicted 9/11. There are lots of events this year and in the last year or two, the war in the Ukraine, the war in the Middle East, and nobody knows how those events will turn out. We also have an election. So how do you think about returns? Again, you should think about them, and we've talked about this a bit before, is that distribution and your estimate is only the middle point, and your plan has to be prepared for either the good tail to show up, which is easy to deal with, that usually will allow you to take chips off the table, reduce your risk because you'll be well ahead of your goal. But if the left tail shows up, you may have to either work longer, plan on saving more. You're going to have to maybe rebalance, and that means, you know, buying stocks at at a very difficult time. But the next point that we want to talk about is this issue of all crystal balls not only being cloudy, but even if you could see the future in some sense with perfect end games,
Mm,
the order of returns, which you can see, can really impact the outcome of your portfolio if you're in the withdrawal stage of that portfolio. So we have a table you can put up that illustrates this point, and the story begins. It's 1973, and we know that stocks have returned 8% in real terms and 10% in nominal returns. And we've had similar results, over the next 50 years since then. All right. And so, say an investor in that time frame says, well, returns were 8% in real terms. I'm going to withdraw in real terms 7% every year from my portfolio because I know with my perfectly clear crystal ball that we're going to get 7% for the next, 50 years. And I'll be dead by then. But if I'm maybe 60 and I retire, I want to live at least 30 years, make it to 90, and I have to plan for even longer than that. So I know with certainty I'm going to get 8% real, and I'm only withdrawing seven, which means if I take out, say, 100,000 just to make the math easy, the first year, and inflation is 3%, to keep my real spending the same, I have to take out 103,000. So now you're clear, you have the only crystal ball that's perfectly clear. And the fact of the matter is that within 10 years, you're bankrupt, as this table shows, because what is called the danger of sequence risk. The problem is if returns are negative early on, and inflation could be high, which is one reason the returns could be negative. Then you're withdrawing large amounts early, and when the market eventually recovers, you don't have that money. It's been spent, and you can't recover. And this shows how dangerous sequence risk can be. So what that tells you is the importance of managing that sequence risk is not taking too much risk early on in the retirement, because if you get that negative outcome, you really could have a problem, be forced into cutting back your spending more than you want, or maybe
mm.
having to move to a lower cost living area.
So you're talking about sequence risk, and just for the people that can't see the chart, the table, basically, this table shows two very significant falls in the market. In the first year in this table is 1973, and the market fell by about 15%, and then in 1974 it fell by about 27%. The rest of the periods, not bad. In fact, if you just look at, you had 75, you had 37%. Even in 1980, you had 32%. So actually, when you look at, if you were to do a simple average of this, it wouldn't be so bad. But it was the point that that 14 and that 15% and that 27% happened right at the beginning of your investing. And for those people that can see it, you'll notice some notes because just like lots of people out there, when I read Larry's books, I take a lot of notes. And in this case, one thing I highlighted was he was mentioning that from January of 1973 to October of 1974, when the bear market ended, the S&P had lost 48%. So that's how you started that period of investing. And for those people that are seeing it, you'll see WB on the right-hand side. I was just fiddling around and looking at what was Warren Buffett's returns in those years. But the point is, how do we deal with sequence wits? And I was asked a question recently, Larry, and somebody said, should I do dollar cost averaging or should I do lump sum investing? And I said to them, well, it basically lump sum investing is always going to be better than dollar cost averaging as long as you know that the initial returns are going to be high and and that ultimately, so you're not dealing with sequence risk. And if you know that you're at the bottom of the market, but of course we don't know that. And then that makes it much more difficult to think about lump sum. So how do we think about this situation?
Well, this question was answered 60 plus years ago by Professor Constantinides at the University of Chicago. And the answer is very simple. From a from a expected return standpoint, you should always invest a lump sum because stocks always have higher expected returns than, say, safe bonds or treasury bills. And that means every day you're out of the market, you're sacrificing expected returns. So from a expected return basis, you're always better off. But what you have to be aware of is that sequence risk exists, and therefore you shouldn't take more risk than you're willing and able to deal with should the sequence risk comes up. And then you should always, before you invest, have a plan B. And
Mm.
what do I mean by a plan B? So you have a plan, and you don't want to plan on the worst outcome happening because then you'll underspend likely what you could have spent. You don't want to plan on the worst 5% in that left tail, like 1973 4, right? We have one of those every 40 or 50 years, right? We had it in 73 4. The next one happened in 2008, really. It was the really bad returns for the market. And the one before that was 29 through 33, maybe, right? So they don't happen often, but they can happen. So plan B says, well, plan A is I don't want to expect the worst because then I maybe only am able to spend 50,000 a year when if I assume more normal markets, I can spend 70,000 a year. Why deprive myself of that? But I have to have what that plan B is to say, if that risk shows up, here's my plan. I will work longer. I will cut out my annual vacation to Europe and drive to, some local beach or something, right? And save that money. I might move to a lower cost of living area. I might downsize. But you should write that into your investment policy statement. So you're thinking about that when you're not under the pressure. Oh my God, what am I going to do? And then your stomach is going to make bad decisions,
Mm.
right? You're more likely to panic and sell rather than, all right, I thought this out. Here's what we're going to do. So that's the way to address that, is to make sure you don't take more risk than you have in the first place. The other point and by the way, maybe if you put that slide up
Yep.
again,
Hold on.
Andrew, just for the people who can't listen, I think it'd be helpful. If we took 7% of $1 million portfolio, you would withdraw 70,000 the first year. But then you have inflation, which was significant. It was 8.8%. So we had to now withdraw to keep our spending the same in real terms, 76,000. But your portfolio was now down to 930,000. And then the market dropped another 26%. Your portfolio is down to 716,000. And because inflation was 12%, you had to draw 85,000. And now you're down to 441,000. And by the end of 1982, when the market went down in 81, you're stuck with less than 20,000 and you're supposed to withdraw 160. So in 9 years, you went bankrupt because of that sequence risk. Now, if you could have waited it out, you would say, 30 or 20 years old in 73, you would have actually earned that 7% real and your portfolio would have been fine. But you don't always have that luxury. So the right way to think about these things are in probabilistic terms. So it should be like, I have a 90% chance of being able to, be able to withdraw, let's say 5% a year from my portfolio.
Mm.
But there's also maybe a 30% probability that I'll have at least $1 million, but there's also a 20% probability that I'll have nothing at age 90. And then you have to decide, is that distribution probability acceptable to you? And if it isn't, then you should adjust your plan.
And just to highlight for those people that can't see, but for those that can see, I'm just going to highlight that I think what you're saying is that we're getting a double whammy. Number one, we're getting sequence risk in the first 2 years. And number two, we're also getting massive inflation in those 2 years. So not only are you losing the value of your investment in the stock market, but you're also losing your purchasing power. And that double whammy is what's really causing you to have to draw down more and have less.
Yeah,
Correct?
and the same thing happened to, although to somewhat lesser degree, in 2000. We didn't have high inflation, but the stock market went down in 2001 and 2. Same thing happened in 2008. Sequence risk showed up there. It was a really bad year.
Mm.
And then it happened again in 2022 when we had a really bad, both stocks and bonds got hit and inflation ran up. So, and luckily, things turned out a little better, but there's no guarantee that that was going to happen, right? And so the benefit of the Monte Carlo is it allows you to look at these distributions, and then it allows you to do scenario analysis to say, okay, let's say there's an 80% chance when you put your assumptions in of success if I withdraw 5% of my portfolio every year. But then you can look at, well, what if I cut it to 4 if I'm willing to do that? And that drives it up to 95% chance. Well, that's a big difference, a 20% risk of failure at 80% versus a 5% risk of failure at 4%. Now, you might decide that, hey, that's worth, I'm willing to sacrifice. But what if it moved it from 80 to 81? Well, most people say, hey, I'm only picking up 1%. I might as well spend the extra money. So
Mm.
the Monte Carlo analysis allows you to do that, shifting your asset allocation to see what that does. If I take a little more risk or less risk, if I shift your withdrawal rates a little bit, what does that do? If I save a little bit more now, what does that do? And you play this scenario, and that can really help you make those decisions.
So Monte Carlo simulations basically construct the normal distribution or the distribution of outcomes, and
You
then
can
you can
run Monte
adjust it.
Carlos with fat tails,
Yep.
but many of them don't.
Yep.
Uh, but the point here is this: even none of us has the clear crystal ball,
Mm.
and we showed you an example. Even if you had a long-term crystal ball, showing a paper, 50 years down the road, and you got the result you wanted, but didn't know what happened occurred in between. Even a clear crystal ball would not have helped you unless you got the newspapers in between. Let me give you one other great example,
Mm.
which just happened this month, even with a clear crystal ball. I think it was September 18th that the Fed announced its change in interest rate policy, and they lowered rates. I'm willing to bet every one of your listeners would have bet the yield on the 10-year would have fallen. I think at the time the 10-year was at 375. It's now 404. So if you bought long-term bonds at that time, you would have taken a bit of a bath. Uh, uh,
Mm.
at that point. So that's a good example. And, none of us has that clear crystal ball that tells us what will happen.
So let's talk just briefly about the concept of extreme values on that distribution. Larry's written a book called Reducing the Risk of Black Swans, where he talks about that. And those are extreme values, are a different factor. But I think what we're talking about right now is understanding that it's a range of outcomes. And it could be even the statistics that you've shown in 73 and to 82. We're not talking about 3 or 4 or 5 standard deviation events. These are, kind of normal outcomes.
Yeah.
My question to you is, this is my last part is it's very possible that from today forward, the next few years, we could see strong negative returns. Possible. Some people are predicting that. Let's say we get 2 years of minus 20 or 30% or something like that. It's also possible that we could face an inflationary period. We certainly printed a lot of money. And so let's just imagine that we're going into, for a moment, to do this as an exercise, we're going into a 73, 74 period where market's going to be down by a sizable amount and inflation's going to be up by a sizable amount. And let's now imagine that, yeah, we're not talking about a 20-year-old who has, 70 years to compound. We're talking
That's
about
the
a
best thing that
60-year-old.
could happen to a 20-year-old as long as they don't get unemployed, because prices will be much lower,
Buy
which means
more.
expected returns will be higher.
Yeah.
But it's the worst thing that could happen to a 65-year-old who's
So
about
let
to retire.
let's say that let's now say we have a perfect crystal ball. We picked it out. We think we've seen the negative scenario. We think it's going to happen. Let's just imagine that we're right. And how would we prepare ourselves for something like that?
Now, the better question related to that is we all agree that that's possible, which means you must build that possibility into your plan, regardless of what you think is going to happen. And
Okay,
we have discussed many
great lesson.
times
Yep,
the worst mistake maybe that people make, and certainly it's the most common, is they're overconfident of their abilities to see what is going to happen.
mm,
Uh, and so you must build that possibility and think always in probabilities. So the way to deal with what is very simply put is uncertainty. We don't have certain future.
yep,
There's only one way logically to deal with uncertainty, and that's diversify across assets that have unique risks. So you don't have all your assets in the risks that could expose. So, for example, if you own a lots of stocks that could get hit, and the same time inflation is a risk to you because you're retired and not working, your wages aren't going to go up with inflation, and you're not the same as that young
mm,
tenured professor at some university who's not going to get unemployed, right? He's rooting for that bear market if he's smart, right? So he could buy a lot cheaper. You're stuck. So you shouldn't own a lot of long-term bonds because that sequence risk combined with high inflation would kill you or could destroy you. So my belief is you should be, all investors basically should be hyper diversified, not just owning the traditional 60-40 stocks and bonds, because there are periods like you saw,
mm.
73-4, and a reminder was 2022, when stocks and bonds both can get killed. And I can certainly construct an argument for why that could happen again, because of all the budget deficits that the whole world, all the industrial world is facing, and all the fiscal stimulus that's incurred. So it's possible. So you want to own lots of assets, maybe that don't get hurt by inflation, right? Things like private credit, which is all floating rate debt. But there you want to make sure it's not exposed to a lot of credit risk. So you
Mm.
don't want to own a lot of junk bonds. So I own senior secured and backed by private equity. The fund has an average LTV of about 40%, a 20-year history of less than 1% defaults, and default losses are less than that. And the fund is currently yielding 11.5%, and it's all floating rate
And the
debt.
correlation is
Is close to zero for stocks. It's non-zero. Clearly, if we get a bad recession, defaults would go up, but but it will go down nowhere near as
mm,
much as stocks, maybe 10% or 15% as bad as the stock market. I own things like drug royalties, structured life settlements that, basically buy life insurance policies. All right. Their returns are totally uncorrelated. I invest in drug royalties, reinsurance. None of those things correlate at all with either stock. And in fact, some of them are inflation protected because their underlying money is sitting in treasury bills or floating rate notes.
and in,
And
in
I also own
in the back of the
stocks.
book, you've got on page 269 a list of reinsurance, alternative lending, diversified alternatives. giving
Right.
some, great either funds or ETFs. So, yeah.
And I'm 50% of my portfolio is there because I'm a big believer in hyper diversification. Now, 10 years ago, I will say that I wouldn't have owned any of these funds because the ones that were available were way too expensive, typically 2 and 20, meaning 2% annual fee and 20% carry, which meant that the providers were taking all of the benefit. Just think about, say you own a hedge fund that's getting 15% gross returns. You're charging 2 and 20. The 20% is 3%.
Mm.
2% is 5. You got 10. The market got 10. And you've got daily liquid in the market. You're trapped maybe for a decade or longer, and you're
Somebody gets
no
rich with
better
hedge
off.
funds.
Today, right, today you can invest in Cliffwater's fund for roughly 1% and no carry. Same thing true. You could have invested in private credit through what are called BDCs or business development corporations. Their typical fees are over 4% because of the high
Mm.
fees and the carry. Cliffwater's fund effectively is about 1.25%, no
So,
carry. So you're able to capture, as I said, that fund is yielding 11 and a half after fees today, when a high yield fund, the Vanguard, is yielding something like 6 or 7, and it's got 6 years of duration risk. So you've got riskier credits based on the historical data. You've got 5% or so lower returns, but it's a lot cheaper. It maybe only costs 18 basis points. So some people, these
go
are
to that
people
one.
I define as people who know the price of everything and the value of nothing.
Mm. So,
Focus only on expense rates, which are important, but they shouldn't be the only criteria.
So, for the listeners and viewers out there who already have the book, just go to the back appendix A, and Larry's got the list there. For the people that haven't gotten the book or that are listening, what would you say? What would be one instrument that you think would be worth somebody who doesn't have any alternatives? They have stocks and bonds, maybe a little gold or something like that, but they don't have any alternatives. What would be one that you would say this one's worth investigating?
Yeah, well, to me, the most logical and easiest for people to understand is reinsurance. We all know that we don't like buying insurance. And the reason is we know we buy it because we need it in case of a catastrophe.
Hmm.
But we not only know we're likely transferring a profit to the insurance company, but we're also praying we never collect it, right? We don't want to collect that premium. We don't want a house to burn down. We're happy to lose money. So, how about, wouldn't it be nice to be on the other side of that trade? Where you're collecting the premium. Now, that means you have to accept the risk. You know, all risk assets
Yep.
have long periods of poor performance, and
Yep.
that's the
Yep.
investor's biggest enemy. We've talked about recency
But the
bias.
point is, I think the message from what you've talked about sequence risk is that what we really need to do is do everything we can to protect the downside during the bad time, and then you can survive a little bit better. Now you've got three reinsurance ones here: Pioneer, Stone Ridge High Yield, and Stone Ridge Reinsurance Risk Premium. Is there one that you would say that an investor should go and start reading the prospectus and understand it?
Well, if you need and insist on liquidity, which most investors don't need,
Hmm.
at least higher net worth individuals, right? And certainly if your money is in a retirement tax advantage account in the US, you're not likely taking that money out. Even if you're in retirement, you're probably only taking 3, 4, 5, 6% a year. And the fund provides a minimum of 5% liquidity every quarter. So that's 20% you can get out every at a minimum.
Which one are you talking about?
But the SHRIX, the high yield fund,
Yeah.
is daily liquid. But because it's daily liquid, you have similar risk, but you're giving up the illiquidity premium that you would get in the other fund, the SRRIX. Uh, and so you have higher expected returns. So
Hmm.
I would only own the higher yielding, higher expected returning fund because I don't need liquidity. But if you needed liquidity, you could go with that fund. Now, the Pioneer Fund is an excellent fund also, and it owns some of both of them. So you're getting kind of an in between. I
Mm.
think they jump around their mix, but it might be 75% of the illiquid and 25% liquid. But it too is therefore only quarterly liquidity.
Well, I think that's a great place to stop this interview. And I think we all got to go back and do our research on understanding funds and ETFs related to reinsurance and see as a starting point for one of many different alternative investments that you mentioned.
Yeah, let me just close with this. It's important. So stocks have high expected returns because they're highly risky. We saw that in that chart, 73 4 collapse, 29 33 collapse, 2002 collapse, '08 and 2022, right? That's not a reason to avoid stocks, right? It's a reason to own them because if they didn't collapse somewhat frequently, there'd be no risk. You just have to hold on for a few years, and then the risk premium would go away because everyone would bid up. So it's actually a good thing that stocks on occasion collapse. No one likes it when it happens, except maybe Warren Buffett, who likes to come in and buy cheap, right? The same thing is true of reinsurance. The fund that I own, first 5 years performed virtually identical to what we predicted as the median was up about on average 5% or so over T-bills. The next 3 years were terrible,
Hmm.
lost a total of about 30%. Investors panicked. The fund had 5 billion at the start of that period, 1 billion at the end. Now, one third of the drop roughly was caused by assets falling in value, the losses. The other two thirds were naive investors fleeing. Instead, I bought more because now the expected return was much higher. Because what happens after losses? With stocks, PEs go down and the expected returns go up. With reinsurance, it too has what I call a self healing mechanism. Premiums go up, the deductibles go up, the underwriting standards go up, and therefore the risk is down and you're getting a much higher expect. The next year, the fund returned 44%.
Mm.
Now, every risk asset, every one of the ones I mentioned, listed in the book, will go through some period of poor performance. That gives you the exact reason why you should hyper diversify. Because if you try to guess which one will do well, be it stocks or reinsurance or anything else, maybe that's the one that sequence risk shows up just when you're starting and you blow up. So you
Mm.
don't want to concentrate your risk. You want to diversify it. And there's no reason to think that the stock market goes down and that's going to cause hurricanes and earthquakes and vice versa, right?
So the question that I have on that is when the reinsurance funds had their bad years, were those uncorrelated with the equity market or were they highly correlated at
Should
that
be
moment?
uncorrelated because
Okay.
earthquakes and hurricanes don't cause bear markets.
Yep.
So think about it. Stocks go down about one third of the years.
Mm.
Reinsurance funds go down. Let's say it's not this bad, but let's say it's one third of the years. So what are the odds they'll both go down at the same time? 1 in 9.
Mm.
So that means once every 9 years, it's going to happen. But eight
Yep.
out of 9 years, it's not going to happen,
Yep.
right? And what are the odds that they'll reinsurance will go down 2 years in a row? Well, one third times one third is 1/9, right? So, but that means you should expect, once every 9 years, you're going to get 2 bad years in a row.
But for
And once every 27 years, you might expect 3 bad years in a row.
and for
And that, but it showed up. It can happen. The same thing can happen with stocks.
and for the listeners out there, it's not so. I mean, everything that we're talking about are risky assets, which means that they're gonna have periods where they go down. But what we're talking about when we talk about trying to prevent having this double whammy of your overall portfolio going down and also experiencing inflation, and not having a lot of time left for your, you're not going to be able to regenerate if you're 60 or 70 or something like that. The idea is, if the assets are uncorrelated or low correlation, then that means that generally they're going to go down at different times. So when the market does go down, if you can find an uncorrelated or a low correlation asset, what you can see is that if that correlation exists at that time, that you're going to preserve the value of your portfolio a little bit. Of course, you're going to give away some of the equity upside, in the overall long term. But that when we get to this point later in life, and we have to be very careful about sequence risk and the like, that diversification really has some value.
Yeah, the way to think about it is stocks go up, but they go up it like this.
Mm,
When you add uncorrelated assets, your line looks more like this.
right.
And
So
you
just
ask any 65-year-old or anyone near retirement, and they get to the same endpoint, which would you rather
they said that
experience?
looks like my heartbeat. That's the one I
Yeah.
want. I don't want that
Yeah.
one
You
that's
want,
highly volatile.
you want the one that's looking like a good EKG, not a bad one.
Well, we got to get you onto your next activity. So
Yeah.
I want to thank you for another great discussion, and really a great one about sequence risk, and thinking about that, as well as sequence risk combined with inflation, that double whammy. Not saying that it will happen, but this is something that we have to put into our thinking. Larry also talked about the Monte Carlo and using Monte Carlo analysis as a way to force yourself really to look at the distribution and understand what the changes of different factors mean for not only the average portfolio outcome, but also the wide range of portfolio outcomes. So, really a great discussion. And I look forward to the next chapter, which, wait a minute, hold on, ladies and gentlemen. The next chapter, it's a short one, but there's a lot in there. It starts out with Harry Markowitz quote. This is chapter 17. There's only one way to see things rightly. So for listeners out there who want to keep up with what Larry's doing, just follow him on Twitter at Larry Swedroe, and you'll see his latest work, which some of the latest stuff. I mean, I forward all of your latest stuff to my team to look at and think about. I like the one where you talked about the different economic environments and returns a couple of weeks ago. And also, you can find Larry on LinkedIn. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.